China's latest threats to cut off Australian iron ore has raised major concerns about the ripple effect on our domestic housing market. Here's why. As the COVID-19 pandemic plunged the world into economic turmoil, Australia has stayed relatively strong in no small part thanks to the boom in the iron ore price. This was largely thanks to China's economic recovery plan that pumped credit into domestic products, which in turn increased the demand for steel. Supply lines of ore from other major exporters like India and Brazil were hit hard by natural disasters in the pandemic, meaning China's reliance fell almost entirely to Australia. Simply put, supply and demand kicked in, and the price of iron ore skyrocketed in value. Putting a figure to that, for every $10 increase to the price of iron ore, another $11 billion is added to Australia's export earnings. So, what's the problem? Our increasingly tense relationship with China has resulted in Beijing revealing its intentions to diversify its supply of iron ore. That includes increasing their own domestic production, recycling steel, and moves to become the dominant stakeholder in new African mining sites. Currently, 70% of Australia's exported iron ore goes to China. If that were to dip significantly, the AUD could crash, causing inflation and wages to be hit for years and the domestic housing market to tumble. With a reported communication blackout between political leaders in Beijing and Canberra, it is clear that Australia will have little influence on whatever China does next.